Welcome to the Big Mike Fun Podcast, where you'll learn about advanced wealth building strategies from real estate investing to creating massive ROI and secured retirement profits. So pour yourself a cup of coffee, grab a notepad, and lean in, because Big Mike has got the mic, starting now.
Welcome to the Big Mike Fun Podcast. I'm the Big Mike.
Mike Zlotnik, and today it is my pleasure and a privilege to welcome back my really good friend, Jason Hartman. Hi, Jason.
Hey, Mike, how are you?
I'm doing well. How about you?
Good. I am constantly dealing with these trolls who missed out on the real estate market the last 10, 12, 15 years, and they're upset.
About what?
And they are trying to convince the entire world that the real estate market's going to crash. And they got more evidence than they did before, but I think they're still wrong. We call them the crash bros. So the crash bros are out there giving a message, and I hope to add some truth to that message, some accuracy to it today.
Give me more, please, because a lot of folks are concerned that we're going into a recession, maybe a severe recession. Who knows, right?
Sure.
And I'd love to hear your view of the world. Do you think real estate is going to do well in this environment? The high interest rates are causing a lot of pain and grief for real estate. That's what concerns me most. That the Fed pushed the rates up so fast and so much.
Yeah. So what's interesting about that, and first of all, Mike, I want to say that I am under no delusions that our economy is sound. It is not. Okay. Our economy is built on a house of cards, but that's really always been true since 1971 when we went off the gold standard. Okay. This is an economy built on smoke and mirrors. Okay. But that's true of every economy around the world. We live in this super symbolic economy globally, and virtually every currency is backed by nothing. The US is the most backed currency. The US dollar is the most backed currency in the world because it's backed by the largest military industrial complex the world has ever known. The gold bugs and the cryptocurrency people and the Bitcoin people, they like to say, well, the dollar's not backed by anything, but they're completely wrong. It's backed by 12 aircraft carriers. It's backed by thousands and thousands of nuclear missiles. This is just not true. Okay. So the US dollar is very much backed. Okay. So that's the first thing we need to understand, is that every economy is relative to every other economy. And you mentioned the high interest rates, and that has definitely caused a decrease in housing demand. It's caused some demand destruction, no question about it. But interestingly, and what most people don't understand, is it's actually made the owned houses with mortgages. And by the way, let me just define that. 25% of the country has a mortgage at or below 3%. And 65% of the country has a mortgage at or below 4%. And just over 40% of the country has no mortgage at all.
That's very interesting. So what you're saying is wide majority of the houses today are owned either with no debt or with debt at very low interest rates that was acquired when the ZIRP policy was in place.
Absolutely. So here's the deal. If you want to have a housing crash, you must have a massive amount of distressed sellers. Period. End of discussion. That's it. If you don't have a whole bunch of distressed sellers, you can't have a housing crash. I'm sorry. Okay. It just doesn't work. All right. So what's happened that's really interesting about the high rates causing demand destruction is, for all of these people that have these cheap mortgages, it's actually made their house more valuable to them. And here's what these like linear thinking myopic people just simply don't understand. Something can be more valuable to you than it is to somebody else. So the value of a house on the open market is lower to a new buyer that has to pay 7% interest, give or take, than it is to the existing owner who's paying only 3% interest, because the mortgage is attached to the house.
The mortgage is a liability, but the interest rate on that mortgage feels like an asset.
It is an asset. It feels like an asset because it is an asset. Think about the bond market for a moment. If people understand the bond market, they understand that interest rates and bond values are non-correlating, right? You know, when existing bonds are out there, and those exist, and this is what happened to Silicon Valley Bank, right? You know, this is essentially the story there. I mean, it's not exactly the story, but it's part of this. It's a big part of the story. Okay, when you have a hold to maturity asset like a bond, okay, and that bond is at 3%. We'll use the example of the mortgages, and the current rates are 7%. Then all of those existing bonds got a lot less valuable. If it goes the other way, you have the exact opposite situation, right? Because there's two sides of the trade, right? The counterparty wants the highest yield when they buy the asset, and the borrower wants the lowest yield when they pay for the asset. So anyway,
what you're saying, it makes total sense. It's the price of the bond. So the price of the bond, as far as the Silicon Valley Bank was concerned, on their books, the price of the bond fell. They used the exception held to maturity, not to mark to market. Right. But what you said makes total sense. So if they loan $1 million at 3%, and now the rate is at 7%, as you said, that $1 million, it ain't worth $1 million. It's worth 800,000. Exactly. On the other side of the spectrum, the borrower, if you borrowed the money at 3% for 30 years, and now the interest rate is at 7%, this bond feels like it's worth $800,000. So if you were to pay it off today in cash, now the bank wouldn't accept your offer for 800,000. But in reality, if this bond traded on the market, it would trade for 800,000 instead of $1 million. So that's how it feels like an asset. You gain almost like $200,000 asset on your balance sheet by virtue of locking in that low interest rate. So what you're saying makes total sense.
Yeah, anybody who has ever traded notes or bonds or discounted mortgage notes, because that's a business, that's a market. There's a whole industry that trades mortgages. If you have a mortgage and you are the lender, that you own an asset, that mortgage is an asset for you. And if you've got a mortgage that's paying 3%, you can't sell that mortgage for much money at all in a market where new mortgages are originated at 6.5%. Okay,
you can sell it. Yeah, you're gonna be forced to sell it at a discount. So
at a huge discount.
Would trade for 800,000.
Exactly, at a big discount. So the inverse is also true. If you have a mortgage that's yielding 6.5 or 7%, and the market rate is 3%, your mortgage went up in value to you as the lender, the holder of the mortgage, right? But the opposite is true for the borrower. So
that's right. But the borrowers can refinance. It's a one-way street. You've always talked about this. Yeah. You can always refinance on the way down, and that's the condition today. When people buy houses today and they lock in high interest rates, when the rates come down, you can refi. So the bank's position is actually terrible, because they're forced to hold cheap low interest rate notes held to maturity, and when the interest rates start falling again, the new originated paper is going to get refinanced. It's kind of it's a bad place to be a bank.
Mike, I mean, it's like, without question, I have not found an exception to this, and I've said it on my show many, many times, and no one has countered me or disagreed with this. In mid to early 2020, in the COVID era, I was saying that the Fed has placed a poison pill into the real estate market. And when I say poison pill, I mean, it's good or bad. You know, I guess, it's like one man's junk is another man's treasure, right? The poison is good for one, bad for the other, right? What I mean by the poison pill, though, is poisoning the lack of inventory. Because now, look at the situation we're in. My prediction was absolutely right. I was the first one to say it. I couldn't find anybody else in the media saying this was going to happen. Now we're in a position where tens of millions of people have ultra cheap mortgages, and they have 28 to 29 years left on them. And we have a massive housing shortage that doesn't show any signs of relief whatsoever because of this. Now, there's a couple things that could happen, okay? The only thing that would loosen up the inventory in housing, because inventory is extremely low, I'm going to show you some charts on that in just a moment. And by the way, for those listening on just audio, I have a chart up on the screen that shows the number of mortgages and the interest rates of those mortgages. This is Black Knight and Axios data held by all of the mortgage holders in the country, right, for single family homes. And you can see 65% of the people in the country have mortgages at or below 4%. That's absolutely phenomenal. So I'm going to show you some inventory statistics in a moment, but there is these people that have these cheap mortgages, just like if you had a bond that was yielding a very good yield, you're going to do whatever you can to keep that bond, right? And that's exactly, we have tens of millions of people in this position. So they're just not going to be motivated to sell their houses. Now, look, life will happen. There will be reasons they want to move or need to move. And a lot of people already want or need to move now, but they're not selling because there's no way they're going to go out and replace a 3% mortgage with a 6 or 6.5% or 7% mortgage. They're just not going to do it, right?
So agreed. Let me just comment on this very quickly. One just quick comment. Life needs to happen for these folks to sell. They basically have to get laid off. So demand destruction. Even
then, I'm going to talk to you about that, but go ahead.
Basically to force a distressed sale or a motivated sale, the has to be distressed seller from that point of view, unless something else happens. But of course, they don't want to sell that house because it's a very valuable asset. But if they lose the job, they can't pay the mortgage. So what do?
Yeah, well, remember, their mortgage is very cheap. That's the first thing to understand. So it's not a difficult mortgage to pay. And even in the face of economic distress, which I believe is coming, by the way, I'm under no delusions that the economy is okay. It's not okay, right? But even under economic distress, you have to always ask the question, compared to what? So what else are they going to do, right? So say, for example, the tens of millions of, look, like we've got 13.1 million plus 4.7 million plus 285,000 people with mortgages at or below 3%, right? So we'll round it off, we'll call it almost 20 million people, right? Say these people get laid off from their job. First off, their mortgage is very affordable. It's easy to pay that mortgage. They could probably pay it with unemployment insurance. It's so cheap. And think about their thinking. If they have to move, what else are they going to do? Well, they're not going to be able to buy a house because they're not going to qualify for a mortgage with no job. So they're going to have to rent. And rents have just skyrocketed. This house is cheaper to own than it is to go and rent a new, lesser apartment. Okay. So you say, well, Jason, they're forced to. It doesn't matter. Okay, so they could live in their car, right? They could live in the car. But in terms of replacing that house, they're not going to be able to do it. So the likelihood is they're going to rent that house out. They're going to rent one room of the house out. They're going to do Airbnb. They're going to get a roommate. They're going to do whatever. They're going to do whatever they can to protect this irreplaceable thing. And that's what people don't see. Now, people will want to upgrade and move. Let's look at the positive side of the economic equation, right? Say, people over time, they get richer, they save more money, they want to upgrade and move to a better house, right? Well, the likelihood is they're going to keep this house as a rental because they're going to say, well, my payments are so low and the rent is so high, why would I sell it? Okay. Or and this is another thing people might want to look at as investors. And I predicted this back in 2020. I didn't act on my own prediction, unfortunately. I would have benefited greatly. But stock in companies like Home Depot and Lowe's and the remodeling business is going to be a great business going forward. Because instead of selling the house, people are going to remodel the kitchen, remodel the bathrooms, fix up the house, and stay put. They're going to add a room onto the house, whatever, because they want to keep that cheap mortgage that is not transferable.
Yeah, so I agree with you 100%. Everything you said is right on the point, makes great logical sense. And it's really amazing and fascinating that people will do everything possible in their power to maintain that valuable asset, that cheap mortgage, even if they are distressed and they lose a job. And when they upgrade, it's a pretty clear, from a decision perspective. Do you sell? Well, if you need a down payment, right? If you need a down payment on a bigger house, you're forced to sell. But if you have the ability to put a down payment from other funds, you definitely want to keep that house with cheap mortgage as long as you can. Unless,
Absolutely.
again, you have $5 million house and that house ain't going to rent for a great rent to valuation.
Right.
But again,
no question about that. But if they have a $5 million house with a cheap mortgage, boy, they could turn that into a short-term rental. They could rent out rooms. They could do all kinds of stuff. They could host events at their house. I have a friend who has a 33,000 square foot house. and he and his wife, once or twice a month, I don't know if they're still doing it. They're quite rich, but they used to host weddings and let people rent their house for weddings. Okay. And, they would get 4 times the amount of 1 month's mortgage from hosting one wedding. So it's pretty amazing. The other thing we've got to think about, Mike, is in the face of 10 consecutive radical rate hikes, let's comprehend for a moment that, a typical $300,000 house, the mortgage payment has increased by 70%. And they still haven't killed the real estate market. That's like an amazingly resilient asset class. I bet no other asset class could withstand a 70% increase in the monthly cost. Certainly not the automobile business. If someone, was looking for a new car, and in the course of 7 months, the monthly payment on that car went up by 70%, they would just give up. There'd be no way they'd buy the car, right? But amazingly, people are still buying houses. In fact, our business is fantastic. I mean, it's really quite good. Now, it did take a breather when we had the initial rate hikes go up. And by the way, my business is helping investors buy properties nationwide through a referral network where we pick the best markets, we pick the best teams, and we refer clients to them, and they buy these investment properties. So here's a good metaphor, Mike, for the way the market is now. I like to liken it to a sink. So let's take your bathroom sink, and the faucet represents the new inventory coming onto the market. Right now, that faucet is just a trickle. There's barely any housing coming on the market. The water in the sink represents the existing inventory, and the water draining out of the sink represents the demand, the buyers buying houses, the absorption rate. So what's happening? Well, we know that the faucet is at a trickle. Hardly any new homes are coming up for sale. There's very little new inventory. The current inventory, the sink, if we called a full sink, not overflowing, but just completely full, to be a normal market, right? If that was normal, right? That means right now, the sink only has 1/3 of the normal amount of water in it. So we only have 1/3 inventory, missing 2/3 of the inventory. There's just over 400,000 homes for sale in the United States. And to be in a quote unquote normal market, most experts would tell you there needs to be about 1.2 million. Now, I want to say something on that before people comment below, okay? I'm using Alto's statistics, which is active listings in the MLS, actual properties you could buy today. The National Association of Realtors has long-time published inventory statistics, and they do it differently. They use all the active listings, plus all the pending sales, plus all the contingent sales, so their inventory numbers look higher. You can use either one as long as you compare apples to apples over time. So if you wanted to compare the NAR numbers, you would look at today's number, and then you'd look at 2 years ago, 3 years ago, 10 years ago, whatever you want to understand what's going on. And the ratios are about the same. But I like to only look at actual properties you could buy today, which are the active listings. Okay. So here's what's happening with the drain, though. The drain is clogged. The demand has declined. The Fed, with its 10 consecutive rate hikes that are the most historic, quickest, most radical tightening policy probably in history, right, has caused some demand destruction. So that drain is about 20 to 30% clogged, and the water is draining out more slowly. Fewer buyers can afford to buy. But the sink only still has about 1/3 of the water it needs, and the faucet is trickling, hardly anything coming up for sale.
So the inventory is still shrinking because the drain capacity to absorb more water or buy more houses is still greater than the new inventory coming on the market.
Yeah.
But let me ask you a follow-up question. What's happening with the new construction? Because basically this is all about existing.
Yeah.
Is the new construction product coming to the market? The cost of construction has gone up obviously during COVID, and you've got much higher debt service for the developers to build those properties. So what's happening on that front?
It's a great question, Mike. So remember when we talked a few minutes ago about the existing mortgages and how people with these cheap mortgages don't want to sell their homes? And that is true, whether they be investors or owner occupants. But the builders are in a completely different situation. They don't have cheap long-term debt. They have either no debt, or they have equity partners, or they have short-term debt. So they do need to unload their inventory of homes. The problem is, and by the way, everything I've talked about is a discussion about the overall housing market. All areas in this huge country, nationwide, we've got about 400 metropolitan areas in the country. We've got over 3,100 counties and over 9,000 cities. And in all of those markets, we've got various price ranges and product types. So you have to peel back a lot of layers on this onion to really understand what's going on. And this, of course, is what we do every day. New homes. For the past 15 years, coming out of the Great Recession, there has been virtually zero entry-level home building. There is a little bit, but for all intents and purposes, it's a statistical blip on the radar. It's nothing. It's a bucket of water in the ocean. Okay, there are hardly any builders building entry-level homes because they can't afford to build them. There's simply no profit in them. With all of the regulations and all of the things that builders need to pay for, and all of the increasing construction materials costs, which by the way have come down a bit, thankfully, but they're still high. With all of the diminishing labor market for construction workers, the average construction worker is about 50 years old nowadays. I mean, just imagine that for a moment. In the past, a construction site was full of guys in their 20s, mostly their late teens and early 20s. Okay, physically robust young men. Okay, that were out there swinging hammers and building houses. Nowadays, the construction workers have just aged, and they're not being replaced. The generation we have of younger people is just too spoiled and unwilling to do construction jobs. So there's a huge shortage in that labor market, and labor prices have increased dramatically, and the ability to even build at all has been very challenging for home builders. So those are a couple factors to understand. And when we look at the new home market, there are finally, because of the huge demand during COVID, there are finally some decent amount of new homes coming up for sale. But again, it's a blip. It's just not nearly enough to satisfy the imbalance of low supply and demand, even though demand is a little bit lower than it was when rates were really, really low, of course.
So there's a lot of great data points there. Let me kind of ask some follow-up questions and some comments. So on the labor side, yes, we have historically low unemployment and massive shortage of labor. And it's unclear where all these folks, we are getting large amount of undocumented immigration. Used to be called illegal, now they're called undocumented.
Well, actually, Hillary Clinton calls them workers without papers.
Okay, whatever you want to call them. In theory, used to be, and I, I'm not trying to be stereotypical, but a lot of folks in the construction industry were coming from the South American countries.
Sure.
So you here go to a construction site and Spanish is spoken as the primary language on these construction sites. So is this still happening? So is the inflow?
It's not enough to solve the problem. I mean, it'll help. The illegal aliens coming across the border, once they're trained and skilled and assimilated into society, for the ones who get to stay, yes, that will help. But look, that's been going on for decades. This is not a new phenomenon by any means. And what we've seen is that a lot of those people are maturing in their prosperity and their success path and live nice middle-class lives. So, it's not like they're going to go swinging a hammer either. Okay. They stay in that low-level socioeconomic spots for a certain amount of time. And then, they move up the ladder too. That's what's great about America.
And that's why everyone is coming to America for the reason that it is, like you said, it's still the greatest power in the world, still the best political system in the world, and so on.
Oh yeah, of course, the U.S. is the best deal going by far. It's far from perfect. It's definitely declining, but it's still better than everybody else. But remember, all those people coming across the border also create more housing demand. They all need a place to live. Are they going to build their own
housing
place?
Is in major lack of supply and massive demand. Agreed. Yeah. So where are we going from here? So the demand for these houses has been somewhat reduced, but the supply has been reduced more.
Even more. Yeah.
So
where we're going from here is that unless a couple of things happen, which I'll be happy to talk about, we are likely to face a housing shortage for decades to come. Decades. We are going to be in a savagely short housing market for a long, long time. Now, there will be ups and downs in that cycle. There will be times when the market gets softer and times when the market is even more difficult, right? Things obviously fluctuate. But for all the housing bears and all the people who are frankly just jealous losers because they missed out, because they couldn't get themselves to make a decision and take a risk, or they didn't have the willpower to delay gratification and buy some properties by giving up something, in 2015 or 2019 or whenever, by delaying gratification and putting their money into investments, they missed out. And these people are jealous people that like to do their armchair quarterbacking, yet they have no experience. They read some stuff and they think they know everything. They're wrong. Okay. The numbers just are what they are. You aren't going to magically create a bunch of new housing supply. There's simply no way to do that. Okay. Now, granted, if there's another pandemic and a whole bunch of people die, or if some technological breakthrough happens, allowing and change, a huge shift in government policy at the federal, state, and local levels, allowing them to create a whole bunch more housing, then yeah, that'll cure the problem. But
let me
those things notwithstanding, I don't know how we fix this.
So a couple of quick comments on this. And so I'll ask first question and then I'll before you answer it, let me provide a comment on this housing shortage. So the question is, what are the economics today for a buyer that goes through your network? As far as the prices are high, the rents have gone up, but also taxes have gone up, insurance to the roof.
Yeah.
So I'm just curious what the investment looks like today. But before we do that, what do you think about this idea? So this has been circulating. I know it's a very hard lift, and it's an idea that's been around, and it's even more kind of relevant now. I don't know if it's viable, but it's relevant. Ton of office buildings are semi-empty.
Yeah.
Just a ton of them.
And some of them are being converted to condos.
Yes, that's
or
the point.
apartments.
Conversion to housing.
Right.
But it needs massive government subsidies because it's difficult to convert office.
It's very expensive to do that, but some are doing it. And I've looked at some of those projects. They're pretty interesting. Yeah.
We've done quite a bit of hotel to multifamily conversions. Those are a whole lot easier and they work really well.
Yeah.
That creates affordable housing. But the office is the next thing in line because hotels are back to doing normal. They're not being sold at a discount the same way they were, when the COVID.
Same with retail centers. You could convert retail centers to housing too. They've talked about doing it with shopping malls, of course. Look, all of that is possible, but it's just very expensive to do those retrofits. Yeah, they're very expensive to do. Some cities have actually eased regulations. San Francisco, believe it or not, is one of them. And I believe Chicago and New York have too, to make it easier and less expensive for developers to convert office buildings to condos and apartments. But again, remember, that doesn't solve the problem for the single family market, right? Look at most people, at least when they form families, and we've got this huge demographic cohort in their prime family formation years of 25 to 34 years old, right? Most of them want a single family house. Yeah, there's some in cities and they'll live in a high rise, sure. But these high rises are quite expensive. They're not cheap by any means. If they're condos, they have very high association fees. It's just incredibly expensive to retrofit them. So all of that is passed through. But to your other point about the rising cost of property taxes and insurance, look, we're very active in Alabama and Florida, Tennessee, Indiana. Some of those are our most active markets right now. And we've been in many other markets. We used to be super active in Texas, Arizona, Nevada. We've done business all over the country. Okay. And those costs certainly are rising in some areas, especially. But just like any corporation, any business, a rental property is a business. And like any other business, it is ultimately a pass-through entity. Everything gets passed through to the consumer, in this case, the renter. Now, it doesn't get passed through right away. There's a little bit of a time lag, and that's what kind of kills people, okay? But ultimately, if someone wants to rent a house, there needs to be a house available for rent. And for there to be a house available for rent, some investor has to do the analysis and decide that's the highest and best use of their money. And if it's not, they're not going to make the decision to buy the property. And if they don't make the decision to buy the property, there won't be a rental. Okay. And this is the problem with rent control and why it's a stupid socialist communist disaster, right? Because not enough people will make the decision, make the calculus to buy properties to rent them out. And that's why there's huge housing shortages in places like San Francisco, Santa Monica, California in general, New York, et cetera, all these places with, failed rent control policies.
Yeah, rent control policies actually raises the prices for everyone else because you take some inventory out of them. But let's go back to the turnkey properties in the markets where you operate, Alabama, Florida, and so on. So taxes are up, insurance is up, absolutely staggering increases in insurance, and whatever you want to call it.
Yeah, but let's talk about the staggering increase in insurance. First of all, that applies to older homes, and our clients aren't buying older homes, okay? These older homes in, say, Florida, or the Gulf Coast of Alabama that are, near the beach, that are very hurricane susceptible, that are properties that, I hate to sound callous, but just economically speaking, they need to be destroyed because they're just obsolete houses. They need to be rebuilt. Okay. And every time Mother Nature comes along, they usually do that for us and force the decision, right? Which should have been made anyway. Okay. So these are not the types of houses that our people are buying with massively high insurance. Okay. But insurance is socialized to some extent. So it does go up for everybody, even if you don't have one of those houses, right? So, if insurance goes from $1,000 a year to $1,600 a year, that's $50 a month. That doesn't change the deal. Okay, you can get a tenant to absorb $50 a month in rent increases. Okay, so that equation is not as startling as it may seem. Now, if you have some crappy old beach house built in the 50s on a beach somewhere in Florida, that insurance might be $6,000 a year. Okay, I mean, it's enormously expensive because they just know the next hurricane is going to just wipe that house out. Okay.
So what is the typical product today? Just curious, just today, what is
brand new construction, and that the vast majority of the properties.
At what price and what kind of rent? Just curious.
The vast majority of the properties we have today are brand new construction. Now, Mike, as you well know, because we've known each other for many, many years, sometimes our market is renovated houses. Okay, that fix and flippers buy, renovate for a profit, and sell to our investors that are the long-term holders. But right now, there's no inventory in that because nobody wants to sell any resale houses, right? So all of the inventory virtually is new homes. I mean, there's a tiny little bit of renovated older houses, but very, very few. We hardly have any of that. So they might buy a property that's starting brand new, starting at maybe $280,000, and that property will rent for $1,800 a month, maybe $2,000 if you're lucky. Okay, and those numbers work fairly well. They're definitely not as good as they used to be, but they work fairly well. And what we have to understand is that rents always lag prices. So we've seen tremendous run-ups in prices over the past couple of years. And the rents are catching up. Now, let's talk about rents for a second, okay? Because most of the rental data that you might see or read is based on multifamily housing. And the multifamily market is very different from the single family market. It's very hard to get good, reliable data on single family homes for rent. There's just not good data on it. Zillow has a decent index called the ZORI, the Zillow Observed Rent Index. Okay, there are some others, but none of them are great. And I want you to just think about this. Look, I've owned, zillions of single family homes over the years, and I've had apartments, and I've had, I've got a mobile home park, and I've, dabbled in some other stuff. Okay, but I have never, in all of my decades of doing this, I have never received a survey from any company or government or anybody asking me about my single family home rentals. No one has ever called me and said, hey, we want to get a pulse on the market for a survey we're publishing. On your single family properties, are you able to ask higher rents, or are the rents really soft? Do you have to give more incentives for people moving in, or can you charge a really high security deposit? Are you having to underwrite the leases at low credit scores, or can you demand the best A-tier credit tenant? No one has ever done that because it's a very hodgepodge, fragmented market. Okay, now on multifamily apartment complexes, it's super easy, and there's lots of companies that do this, to call up the Irvine company, Irvine Apartment Communities in Southern California, that owns thousands of rental units, or Sam Zell's company, Equity Residential, and call them up and say, hey, with your thousands of apartment units, what's going on with your rents? Give us the vibe on the market, right? And that's super easy for them to do that. Okay, so just understand that single family home rental data is not great. Okay, it's getting better, but it's just
fragmented because you have very fragmented ownership versus apartment complexes are much more corporate owned,
institutional.
Yeah, so I appreciate the wisdom. It's great episode, Jason.
Hey, Mike, before we go though, I want to share one more thing. I didn't share this yet. Okay, so on the screen, I have got a graph of housing inventory, okay? And this is really, really telling, okay? So for those of you listening on audio only, what it's showing is right now, as we speak, inventory has fallen in the United States. I mean, nobody would believe it that with mortgage rates this high, that we would have inventory of only around 420,000 homes for sale in the entire country. I mean, think about it. We have a country of 332 million people, I think, only 420,000 houses for sale. And let's compare this to prior years. 2019 is a good year to compare to because it's right before COVID. And at this same time of year in 2019, the inventory was more than double what it is now. More than double. In 2018, basically the same story. In 2020, it got a little lower because people were taking their houses off the market. They didn't want someone coming over and coughing on them and giving them COVID, okay? So 2020, everything was starting to get locked down right about this time, and not much we saw inventory falling, okay? Let's look here. Let's look at 2017. Inventory was way more than double what it is now. And then, of course, we see during the COVID era, when we look at 2021, 2022, inventory was just savagely low. I think the lowest point, Mike, just for comparison, was 243,000 homes for sale in the country. And everybody remembers that. Multiple offers on everything, no choices whatsoever, an absolute feeding frenzy. Houses that would go on the market and within hours would have many, many offers, some having dozens and dozens of offers. It was just a savage market. So now we're at about 420,000. What we need to be normal, if you took this chart back to 2015, which it doesn't go back that far, you would see about 1.2 million homes for sale. And Mike, we knew each other in 2015, and business was great for us and the market was good and properties were selling. And, that was a normal inventory market with about 1.2 million homes for sale. Now we only have 420,000.
Yeah, this is great data. Appreciate, Jason, you sharing this. So I guess on a forward outlook, the chances are the inventory are going to slightly increase over time. Again, we're still coming out of COVID. So hopefully over time, inventories will gradually improve. But I guess a lot depends on the interest rates. So before we wrap up, just a couple of quick comments. What do you think is going to happen with the interest rate and Fed kind of action for the rest of the year into next year? A lot of folks have talked about this. There's a lot of speculation when the Fed will start easing. They might still do one more quarter increase. They haven't said that they're done. They're getting close to being done. But don't you think that more and more problems are going to hit the economy and they're going to have no choice but to ease? And a lot of banks, we talked about this, a lot of zombie banks.
I mean, the Fed, look, it's very hard to predict interest rates. And I have done a terrible job at predicting interest rates over the years. So that's the first disclaimer I'm going to make. I've been very good at predicting other stuff, but interest rates are a tough one because they're centrally planned, okay? But if you ask me, I'll throw out my prediction. I think the Fed is going to be forced to pivot. They may raise one more time, or they may just let it go at the next meeting and keep it even. But then they're going to start cutting because things are breaking. Banks are failing. Banks have these hold to maturity assets, which the Fed is making less valuable with their high interest rates. And they're going to push us into an official recession. Okay, we're definitely not in a recession yet, but I mean, there are kind of signs that we should be, but the labor market is so strong. I mean, look, we hear about some layoffs at tech companies that were overstaffed anyway. Okay, overfunded, overstaffed, woke people working there. Just stupidity. All right. I mean, look, Elon Musk, when he took over Twitter, he cut that company by 80%. And it still runs, okay? So, these tech companies are massively overfunded, massively oversupplied in terms of labor. So now they're getting to be real businesses. That's all that's happening in an adjustment. One thing that does concern me, and I don't know which way to think about it, is the massive impact of artificial intelligence. And, on one hand, obviously it's going to put a lot of people out of work. But on the other hand, it's also going to create a lot of prosperity and progress. So it's hard to evaluate how that's going to play out. My sense of it is that we're going to see times of pain as there are job losses, and then we're going to see a follow-on time of increased prosperity and increased choices and increased opportunities. But again, there's always lag times. Look, folks, if there's one message I want you to understand from what I say, it's the lag time that kills people. There are always those adjustment periods, and it's going on right now in real estate. The rents have yet to catch up with the prices, right? We know that there's a shortage of housing. No one can deny that. One guy does on YouTube, but he's wrong for many reasons. But rents will increase more and more and more, okay? Because the single family market, unlike the multifamily market, is not oversupplied, it's massively undersupplied. And the rent stats are for the multifamily market, the ones that mostly everybody's seeing and reading. So I think the Fed is going to be forced to pivot and cut rates. And, as I see it, rates probably settle at around mortgage rates. When I say rates, I'm talking about mortgage rates, not Fed funds rate or treasuries. Mortgage rates probably settle somewhere in the 5% range. And when that happens, coming into a market with only 1/3 of the housing inventory we need, it's going to light the housing market on fire. Okay. It won't be as good as it was before. At 3%, of course, it won't be that good. But people need a place to live. And, I don't know how they're going to create it out of thin air. It's just not going to happen. It's not going to be 3D printed homes. I've researched that in depth. I've done many shows on it on my podcast. 3D printed homes are dramatically more expensive than anybody says. If it made sense, you'd see it everywhere. You don't. There's a reason. That I think that's what we're going to come into. We're going to see rates settle somewhere in the 5% range for mortgages, and we're going to see the housing market just get treacherous again. Not as bad as before, but it's going to be savage lack of inventory. It will cause a few more people to put their house on the market, because the delta between the rate they have and a new mortgage at 5%-ish will not be as large. So that'll be an easier calculus for people to make. But as soon as those houses come on the market, they're going to be snapped up, because they're going to be cheap for the buyers too.
Yeah, I mean, you basically, as the rates will cycle back down, which I strongly believe too, as more things will break later in the year. But you can't almost call a recession without some level of meaningful unemployment increase.
Right.
In the past cycles, unemployment would have to go to 6% or higher for real recession to take place. We are at a point of historically low unemployment. It's not even clear when do we get over 4%. I mean, we can't get to that number. But I agree with you as far as the interest rate cycling down. You're going to have a lot more demand, right? You're going to have more supply going into the market, and then some more new construction, right? At least developers will find it economically more interesting to build as interest rates cycle back down. So
right. The one thing we didn't cover in that analysis, though, Mike, is just general inflation. And I think we're going to see in the coming years just a lot more inflation. And remember, that inflation makes the building materials go up, it makes the labor costs go up, it makes the energy costs go up. And so that's going to make new build houses more expensive, or remodeling houses more expensive too. So
stop for a second.
Yeah.
More inflation. So you don't think we're coming back to what the Fed has called 2 to 3% annual inflation? You think it's going to be staying at an elevated level? What level? I mean, given comparison to what the data is reported today.
I mean, look, during the COVID era, they created so much increase in the money supply. Okay. And that's still out there sloshing around. I mean, they're tightening it up, but there is just so much evidence, even pre-COVID, that the future is going to be very much inflationary. Now, look, there will be times of disinflation, maybe even deflation. And again, this is by no means an even thing. You got to peel that onion too, right? There's a difference between consumer inflation, asset inflation, wage inflation, right? There's pull inflation, push inflation. Like anything, it's complicated, okay? But generally speaking, the overall big macro trend is inflation. If there's 1 year of disinflation or even deflation, okay, fine. But the big long game is inflationary, in my opinion.
Yeah, I agree with you. We can't stop printing. I mean, the growth of M2 money supply has slowed down and it's been shrinking slightly. But on a relative basis, the shrinkage relative to the increase that we saw during the COVID, it's a drop in the bucket. And in the upcoming years, that growth will continue, probably pace faster than. It's almost fiscal responsibility of the government is gone. It's a lot easier to print money, print debt to feed the beast.
Yeah.
So from that perspective,
the business plan of governments is always inflation, Mike, because for them to be able to give out goodies to the populace, to the voters, to keep them in power or to vote them into power, they got to make promises they can't keep any other way than to print.
Yeah, austerity is not the word anyone wants to hear. And
No.
the tolerance for pain, is so small and so short. And that's the reason the Fed probably will take action when real pain starts showing up. So
you're absolutely right, my friend. Yeah.
Appreciate you coming on a podcast. You got to come more often. It's been a few years since you came on a podcast.
Yeah, my pleasure. And if you want to find more of my content, I'm on YouTube, and my podcast is on every podcast platform. Just type Jason Hartman or go to jasonhartman.com. And if you'd like little short bites, follow me on Instagram, Jason Hartman 1, where we've got a lot of short form content. But I really recommend the podcast and the YouTube channel the most.
Thank you, Jason. Thank you for sharing. Thank you for your wisdom.
My pleasure. Happy investing.
Thank you for listening to the Big Mike Fund Podcast. To receive your copy of Mike's How to Choose a Smart Real Estate Fund book, head to BigMikeFund.com or visit Amazon and type Mike Zlotnick. Keep listening and keep investing Big Mike style. See you on the next episode.